Hello, welcome to the last topic. Today we are going to be discussing on lot size, leverage and margin. So this is also a very important topic, and you're also going to learn something new, being it a beginner, intermediate or an advanced trader, as I'm going to go very deep into it. The first one is actually going to be what lot sizes are. We're going to try as much as possible to understand what lot sizes are, understand the types of lot size available in the forex market, and some small calculation on how to determine a lot size depending on the lot you are using. We're also going to talk of what are leverages in the market and the importance of you using leverage. We're also going to discuss the various types of leverages which are being offered by brokers. For example, like we have the low risk, the high risk and the medium risk leverage. We're also going to talk of what margin is in trading, which I believe most people which are somehow intermediate might not really know much, and it's actually going to help you. So this should not be a video you want to miss. After this very topic, we're going to be moving directly to technical analysis, where we are going to start teaching you how to actually perform the real strategy itself. But this basic is very good, so that you can be able to lay down a good solid foundation for yourself, so that when you are now learning the technical, you can be able to perform very well, and you should be able to understand it and at least have a good background when it comes to trading. Without wasting any time, we're actually going to look at what lot sizes are. So what is lot size in forex? So when we talk of lot size, it's actually the amount of volume or contracts you buy or sell each time you place a trade in the market. So anytime you press that buy button or that sell button, lot size is what you use. So it's the amount of volume you inject into the market, whether you want to buy a currency or whenever you want to sell a specific country currency. So let's try to look at different types of lot size available in the forex market. Basically, you have three main types of lot sizes available in the forex market. The first one actually being the standard lot, the second one being the mini lot, and the third one being the micro lot size. After understanding these three lots, we can also break them down in different ways for you to understand it more better. So a standard lot size is made up of 100,000 units. So it is actually being represented in our trading platform as from 1 to infinity, which means any lot size you execute on the forex market so far is from 1, 1.5, 2, 3, 4, 5 or 10 or 1 million, whatever lot size we are using, we refer to it as a standard lot. So the minimum units of a standard lot is 100,000 units, which means if you open a standard lot of 1, you have purchased 100,000 units worth of contract in the forex market. The second one is the mini lot size. So mini lot size consists of 10,000 units. So if you purchase a trade which is either through a buy or a sell with a 0.01, which it simply means that what you have bought a 10,000 units worth of that contract in the market. Lot size is what the broker show us or what we use in trading, but what you are actually buying is in unit, and those units are in pack. When you now separate it, it cannot give large amount which you're actually buying, because for you to make profit you have to buy in bulk in the market. Currencies are in units. That's why you'll be seeing 1.00 this whenever you are reading the country currency or the unit of a country currency. It is always having 1 point something 000. That is the amount, and you always have those zeros there. Those zeros also are being derived from those units. So these units are very important for you to understand them. So if you are opening a trade with a 0.02, it simply means you are buying a 20,000 unit worth of contract in the market. Same as 0.007, it means you are buying 70,000 unit worth of contract in the market, which means that's your volume which you are actually buying it. We have micro lot size also, which actually ranges from 0.01 to 0.09. So any lot size within this range is being represented as micro lot. So if you purchase a currency with a 0.07, it simply means you have bought 7,000 worth of contract of that currency, and these currencies are being bought in bulk. So for you to understand more about this country currency, you can actually get to me or ask questions or join the WhatsApp group or the Telegram group from the link in the description, and so that you can be opportune to ask questions for me to further explain more, as it is something that is very important for you to understand when it comes to trading the financial market. If you have a standard lot size of 1 and you execute a trade, a 1 pip movement of that trade is actually going to be $10 when Euro US dollar is actually a base currency. And if you are using a mini lot size of 0.10 and you execute a trade 1 pip movement of your trade is actually going to be $1 per pip movement. So when choosing your lot size, or when you are practicing on your demo account, ensure that what you choose a lot size that you truly know that you can be able to fund an account on, because most of us always go and we deposit. When we deposit into our demo account, we go and put $100,000 and start using 5 lot, 10 lot. After you start seeing thousands of dollars and you say, this is how this thing is, I've just been wasting my entire life. And when you want to go and deposit now into your account, you go and fund in now $10, and when you open such lot size, now your account will blow and you are going to be so frustrated. So start using lot sizes which actually match with what you can actually deposit into the market to trade with. Don't go and you start executing some types of lot sizes, and when you are overwhelmed about the results, then you go now and fund in your small $100 thinking that that's the same money you're going to be making. It's not actually the same. So we have the last one, which is the micro lot, which is being represented as 0.01, and the 0.01 here for 1 pip movement, it is actually $0.10, which is known as 10 cents, when Euro US dollar is actually the base currency. So these are some things we need to know. You can perform a mathematics on this, saying that, okay, if I'm opening 0.07, it simply means for every 1 pip the market go, I'm actually going to be losing or gaining $0.7. Or if I'm using 0.10, for every 1 pip the market go, I'm actually going to be making $1 or I'm losing $1. And if you are targeting a 10 pip movement, then how long will your account balance be able to withstand the loss? Always check off the loss first. That is how I teach my students. And if you are somehow maybe saying that, oh, we like losing, no, you have to get comfortable. This is a business that deals with profit and losses, and you have to accept it. So I always talk of the loss first before the profit, because if you cannot train your mind like that, you cannot succeed in this industry. I know most people always be telling you about profit, but that's not about trading. You have to actually get comfortable with losing before you can succeed. If you cannot train your mind in a way that you get comfortable with losing, then there is no way you can actually succeed in your trading. Always ask yourself that if I am taking this amount of lot size and if this trade goes against me, will I be able to withstand that loss? That is what you need to ask yourself anytime. Let's talk a little bit about leverage and margin. So what is actually leverage? So leverage gives you the exposure to trade large amount of currencies without having to pay the full value of the trade upfront. So leverage can be seen as a borrowed money which a broker gives you. So it actually gives you the opportunity to buy large amount of currencies, buy a lot of lots. Those lots are contract. Those units are in contract. So you buy a lot of contracts into the market without actually having that initial money in your account. So that's why when you want to choose some brokers, you always need to look at if the broker is actually offering you the type of leverage that are favorable based on your risk tolerance. So what is margin? Margin is actually the initial deposit you put down to open and maintain or manage a leverage position, which means it's the initial money you actually put into a specific trade to manage that trade. The remaining money is being offered by leverage, and that is being offered by the broker. So let's try to use an example here. So this is actually your money, and this is actually the leverage being offered to you by the broker. So when the broker offers you this leverage, you are now exposed to open a big amount of contract from the market, because that your money has now been multiplied and it is now bigger, which you just deposited small. So that's why leverage is very, very important to you as a trader. Let's try to use an example here. Let's say you have a $100,000 account and you open a trade of 1 lot on Euro US dollar. So with a leverage of 1:100, it simply means that what? The margin required for you to actually control this amount of money in the Forex market is $1,000, which means if you have a $1,000 account with a leverage of 1:1, the maximum lot size to control this amount is just 1 lot on Euro US dollar. If you try to put 1 point something, it is actually going to tell you not enough money, which means it is actually preventing you. So leverage is also preventing your account maybe from blowing off, or it is actually giving you more opportunity. It can make you to earn money actually, or it can take money from you quickly. So it is not good that if you have a big account balance, you should be trading with high leverage. If you have a small account balance, then you can be trading with high leverage. That's one of the advice I can give to you when it comes to leverage. Leverage actually gives you large buying power with just a fraction of your initial capital. Let's perform the example so that you can actually see it by yourself. Without leverage, if you have a lot size of 0.5, and your trade value is actually $50,000 with a leverage of 1:1, the margin required to open that amount of trade is actually the same $50,000, which means even if your trade goes 300 pips in profit, which is even something for swing traders to cash, is always somehow challenging. Not that they cannot do it, but if you are a day trader like me, then you are trying to cash 300 pips. We don't do that. Okay, we just enter and we go out, let's say from 10, 15, 20 to 50 pips a day. That's how we usually do. If you want to trade with such amount, trading will not be a business which you want to do, because it's not going to look favorable, because you'll be carrying $50,000 which you can put in another business, and you come and deposit into your trading account just for you to be able to make 1,500 as a profit if it goes to your direction with such large amount of people who could have given you about hundreds of thousands of dollars. So that's why leverage is important. So if you have a $50,000 account, the maximum lot size you can open with a 1:1 leverage will be 0.5. So without leverage, trading, it will not actually be a business where you will be thinking of actually indulging into. So let's try to look at an example with leverage here. With that same 0.5 lot, which is a mini lot size, with a leverage of 100:1, you actually need just a margin of $500 for you to be able to control this. With $500 and you're using a 1:100 as your leverage, you actually just need only $500 for you to control that amount of money. Unlike when you are not using leverage, with that amount, you are just going to take that 500 times 100. So leverage is a multiplier. It actually multiplies leverage. There are some people that will choose more higher leverage than this one I'm using. So in this case, you are going to use just $500, and if you move the same 300 pips, you are going to make $1,500, which somebody without a leverage on a $50,000 account can still make. Which means that with leverage, trading now becomes a business which you can think of even joining with the smallest capital you have to be able to generate some profit for yourself. So without leverage, if you put 50,000, you can only gain 1,500. But with leverage, if you put 500, you can even gain up to 1,500 on that trade if it actually moves 300 pips in your favor. Think of your broker as the bank who loans you the 50,000 to actually place the trade. All they ask for in return is a 500 good faith deposit from you. You just need to deposit a $500 for him to now multiply that money to turn to 50,000, so that you can now be able to use that your small money you place trade. I know there are a lot of questions that are going to come, so you can join the group, the Telegram channel or the WhatsApp group, so that you can also ask questions if any concerning this, or you can reach out to me privately on my number so you can ask questions on these things. It's very, very important. Your broker or the bank is just asking you that amount of money, that just give only 500, let's turn it to 50,000, so that you can be able to buy much contracts from the market and generate more money for yourself. And in return, you're only going to pay us commission. You're only going to give us commission for us facilitating you to perform that transaction, but our money, you cannot be able to take it out. Now, when you actually exit the trade, the deposit money will actually return into your account, plus or minus the profit or loss which you have actually made from that particular trade. We have different types of leverages. We have the medium risk leverage, we have the high risk leverage, and we have the low risk leverage. So what are low risk leverage? Low risk leverages are leverages ranging from, let's say, 1:10, 1:50, and 1:100. Any leverage from 1:100 now, we consider it as a medium risk leverage. From 1:100 to 1:500, you're actually a medium risk leverage. And from 1:500 upward, a high risk leverage. You can have 1:5. Some brokers even offer unlimited leverage, which means even with your $1, you can even open 20 lot in it, which is even impossible because it's with just the spread. That one will not up to the amount of the transaction cost of that lot size you are trying to buy, because any lot size you are trying to buy into the market, it has its transaction cost. So if you are trying to buy, let's say for example, a one lot on euro US dollar, you might have to pay $10 transaction cost. If your account is not up to that amount, then you will not be able to place the trade because the account balance is not worth up to the transaction cost. Or if it's directly up to the transaction, immediately you place the trade, the account will just turn to zero, which means you have just paid but for the transaction to open that lot size. So that is why lot sizes is very, very important. So as of today, always make sure that the lot size you are opening should match with what you know you can initially deposit into your account, as it is very, very important to you achieving success with your trading. So you need to know high risk leverage actually will lead to high potential profit That's also one thing, and it's also going to lead to a lot of greed, because when you start seeing high potential profit, you'll be greedy to always do it or to hold for more, and it's actually going to give you low success rate. And that is why I was saying that any trader that is a little bit experienced or have more capital should always go for low risk leverages, so that even if you mistakenly want to lose your money somehow, if you place a trade without a stop loss somehow, when it reaches a certain predetermined level, the market should be able to cut you out and allow the remaining money into your account, rather than putting a leverage where you just have to blow off your account to $0. That is going to be so frustrating, and you have to start all over again. So that brings us to the end of these basics, and if you found value throughout this basic course, consider hitting the subscribe button and the like button as well. Let me know what you want to see on the technical level, as we'll be moving to the technical level, and also share this video so that I can also help those who are actually new into trading and want to get started with their journey, because I have a complete beginner program here right from scratch, from someone that doesn't know anything. I've explained it in depth right from scratch to the end, and this is actually going to help anybody that is starting his journey to learn very, very well right from start. You don't necessarily need to go and pay for a mentorship before you can get all these informations that are actually going to give you a solid background in trading. You can get it right here for free. So all I need from you is that you should also just subscribe to the channel so that you can be getting more information, more updates we're going to be sharing, and more strategies we're going to be bringing on in the future. As of now, I'm going to see you guys on the technical side and continue to trust the process.